Hi, everybody. Good morning. Good morning. We're going to start in a couple minutes. My name is Dr. Arnaud Prévost, and I am your host today. It's great to see all of you. A couple of you are still in the waiting room, coming in. It's great to see all of you. Again, my name is Dr. Arnaud Prévost, and I am your host for today. We're going to have a lot of fun, a lot of learning today, where we're talking about balance sheets. Balance sheets. We're going to start in about 30 seconds. I just want to make sure that everybody can connect. That's great. It's great to see everybody coming in here. We should have a couple more coming in as we start. And so, yeah, so it's going to be fun. It's going to be great. I still see Gabe here connecting to the audio here. It's great to see Nick, Shonda, Renee, Deborah, and I look forward to this hour with you all. My name is Arnaud Prévost, and I'm the program coordinator at the Small Business Development Center at Blue Mountain Community College. So this is fun. This is going to be great. More people are coming in.
Oh my gosh.
Hello there. Yeah. Hello there. That's great. It's great to hear everybody.
What? We have $48,000.
We're about to start, everybody. If you could go ahead and mute yourselves. Go ahead and mute.
So does that wake up Oli?
I'm gonna go ahead.
Barking? Isn't her thing above the cloud?
Yes.
I'm gonna mute a couple of you here. I could hear the background, people still talking, but it's great to see you all. This is who we are. We are America's Small Business Development Center at Blue Mountain Community College. It is a whole, we are a team. We are a whole team, and this is great. Eric is our leader, our director. I am the program coordinator, and we have business advisors in every county. As you can see, Umatilla, Wallowa, and Baker County. At whatever stage of the business development process, please make sure to give us a call at 541-278-5833, 541-278-5833. This is who we are. And yeah, absolutely. We are here to help you, again, at any step of the business development process, from business ideation to business growing your business and so on. So we are here for you. Absolutely. All right, everybody. Today, let's start off with video conferencing norms and communications during this session. All right. It's always a good idea to mute yourself when you're not talking. I had a chance to mute a couple of you where I heard some sounds in the background, and it's okay. If you're using your phone, please mute yourself using your phone's mute button. And remember that this session is intended to be interactive. So feel free to go ahead and type in any questions you have in the chat. I like to do that so we can keep a running tally of all the questions that we have in the chat. Or you can click on any of the reaction buttons, and that'll be great. So I have a couple more people coming in here. So if you have a thumbs up, you want to give a thumbs up, that'll be a thumbs up button. You can do the clapping button, any of the reactions that you have there. So yeah, so let's begin. In the chat, go ahead and tell me what type of business you have or are planning to get into, so that we can get to know each other a little bit. Go ahead and do that in the chat. Take a minute. Go ahead in the chat, everybody. So Renee says bookkeeping. That's great. Go ahead, everybody. Keep going. I'm going to wait just a second. I had an alarm just come up and I had to stop it. So we have a couple here. We have interior. We got bookkeeping for entrepreneurs. Awesome. Who do we have here? Interior design, lodging, screen printing, embroidery business. And Nick says motorsports. That's awesome. That's amazing. Well, the idea is, now that we're a little bit more familiar with each other's industries and sectors, we now we'll be able to see how really understanding the balance sheet really will help any business in any sector that you're in. And that's key. So we talked about this last week. If for some of you who were with me last week, why in the world should I care about the numbers in the balance sheet? Well, here are a couple of reasons why. To better understand how hard you're working for the money you're making. That's a very important concept. All right. You better understand how hard you're working. So does the work you do translate into money that comes in and out? That's very, very important. But also to be more presentable to a lender or an investor. That's key. Remember, your business can be the bee's knees. It could be the best in your mind, in your heart, absolutely. But if it doesn't translate financially, that's going to be an issue. That's going to be a problem. And how do you explain that it translates financially? Through the balance sheet, through the financial documents. And so that's key. Number 3, to make tax reporting easier and more accurate. That's right. Making sure, always remember, you got to pay Uncle Sam. And you have to make sure that you are able to have accurate numbers, and that's very, very important. That's why the balance sheet is there, but all 3 documents, but especially the balance sheet. To compare businesses with other similar businesses. How do bank lenders or investors compare businesses to see where they're going to invest money in? Well, they'll look at the financial documents. And that's what's going to happen. That's the idea. So if you want to compare yourself with another bookkeeper, another motorsports company, or something like that, then that is why you should care about the numbers. Also, again, to show your credit worthiness to a bank or credit card company or an investor, absolutely. And very important, at the end of your possession of your business, if you ever want to sell it, to have some idea of the profitability of your business, should you ever want to sell it. That's why we need to always be interested in the numbers, essentially. All right. So our focus today is on the balance sheet. That's right. One out of the 3 main documents, financial documents. The other 2 are the income statement and the statement of cash flow. So on a scale of 1 to 10, all right, go ahead and tell me, 1 being nothing, 10 being you're a pro at balance sheets. In the chat, go ahead and tell me about your knowledge of a balance sheet. So here we go. We got a few 4s here. Nice. Very good. A few 4s. Very good. Oh, we got a 2. That's okay. Remember, our goal right now, Gabe tells me 0. That's perfectly fine. That's perfectly fine. A humble 1. Absolutely. So the goal of this series, of this our time together today, is going to give you the tools to move up on that scale, so to speak. All right, to move up on that scale. All right, so that's the idea. That's the idea. Groovy? Everybody good? All right, so let's start with our first 3 points in the balance sheet. Okay, a balance sheet is what? Well, number 1, very, very key, very, very important. It's a statement of assets and future benefits and claims on them. All right. Number 2, probably the most important part of this slide, is that we're talking about a snapshot in time, like a picture. What does that mean? Well, that means that we are talking about the balance sheet allows you to see how you're doing on a specific day, on any day. In fact, if you take a balance sheet and print out a balance sheet or make a balance sheet every day of the week, each one of them is going to be a little different. Why? Because every day you're adding more business activity, you're putting in more assets, you're putting in more liabilities, and so on. And so it's a snapshot in time. How am I doing today? Now compare that to the profit and loss or income statement that looks at an entire year, all right? Or the statement of cash flow that can look at an entire year or even an entire quarter or something like that. The balance sheet looks at one day, one moment, and that's key. It follows a very, very famous equation. And I would have you write down this equation and post it up on your wall right next to your computer, or the computer where you do all your accounting work. Assets equals liabilities plus owner equity. And that is key. That is, we're going to talk about that in quite a certain amount of depth today. Your assets will be equal to your liabilities plus your owner's equity. And we're going to see exactly what that means. Without this equation, we don't have balance sheets, and that's important. Everybody got it? So let's take a look and go a little bit deeper. Balance sheets are also known as a couple of other things. They're also known as the statement of financial condition or the statement of financial position. So if you hear a statement of financial position, same thing as a balance sheet, okay? A bank might want a statement of financial position. They want to know where you're at a specific point in time today, right? Snapshot, that's the idea. All right, so how is a balance sheet created? Let's start with the general idea, the general function, okay? It starts with that formula, assets equals liabilities plus owner's equity, okay? What are assets? Assets are what you own. Any receivables, cash on hand, we're going to talk about all this in detail. But it's what you own, essentially. That's going to be equal to what you owe, liabilities, any debts, anything like that, any payments you've got to do, plus what you get, any capital profits or losses. And that's going to be key. So you see that equation, it's got to stay balanced. It's got to stay balanced. And you're going to see on the left and on the right side of that equal sign, the left and the right side of that equal sign, let me see, that equal sign right here, boom, 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 boom. Okay, here's that equal sign again here. The numbers have to be the same. And they are going to be the same. All right, very good. Any questions, please make sure to put them in the chat. So that I'll be able to see what I can do to help and answer these questions. Yeah. All right. So let's let's go under the hood, so to speak, of that equation. All right. Assets equals liability plus any equity that you have. So assets, we're talking about any liquid or non-liquid assets, such as cash, bills, any bills owed to you, accounts receivable, money coming in, any inventory, any property, any equipment. Now, this is not an exhaustive list, obviously, but it is I would say it is generally a good list to have, all right, and to understand. These assets, all of these, need to be equal to your liabilities, any financial obligations. These financial obligations are accounts payable, all right, or can be account. Oh, I'm hearing somebody in the background. Make sure that you're on mute. Unless you have a question, then you can put it in the chat, and we can chat and we can talk. Absolutely. But let me make sure that I get through this. So these assets equals the liabilities, financial obligations. What are financial obligations? Well, any accounts payable that you might have, money that you have to pay, any wages you need to pay, any rents or utilities, or something like that, all right? Bank debt, any deferred tax liabilities, okay, all right? And any deferred tax liability, any long-term debt, okay, all right? So those are examples that you can go ahead and take a look at for liabilities. But that's not all. And I see a question in the chat. I'll get to it in just a second. It's also the equity plus the equity. And that means what's left after subtracting the liabilities from the assets. Any common stock that you might have issued, any owner draws, or even perhaps retained earnings at the end of the cycle, right? That's key. That's important. So if we know that, let me see if I can't use the draw function. Assets equals liabilities plus owner equity, right there. Ooh, that pen just vanished. That's weird. Let's try that again. equals liability plus owner equity. We also know that equity is equal to assets minus liabilities. Just swapping that function, that formula, so to speak, in the other way. Okay, so this is how a balance sheet is created. All right, I'm going to check the chat for the question, but give me a thumbs up, everybody, if you all understand this part. Give me a thumbs up on the reaction buttons. I want to make sure that everybody gets this section. Everybody gets this part. Go ahead. Thank you, Deborah. Shonda, thank you. iPhone, thank you very much. Nick, all right, great. You all got it? So that's the general idea. That's the general idea. All right, Deborah asks, are there generic balance sheets that list items on each side of this equation? Well, we have items on each side of this equation right here on this slide, right over here. I will give you a generic balance sheet as a handout a little bit later on in our presentation, and you'll be able to see that, and you'll be able to use it. For those of you who were with me last week when we took a look at all three financial documents together, that handout will be very familiar. It's the same one, so there you go. But for those of you who were not with me last week, you'll have a fresh balance sheet template for you in just a little bit, as soon as we're done with our slides, essentially. All right. Okay, let's do this. So what does a balance sheet do exactly? What does it do? Well, again, it does a couple things. It does a few things. A balance sheet shows what you own and what you owe. It identifies what you own free and clear and what items you're making payments on. All right. For example, someone's personal balance sheet might include their house, their car, their personal belongings, their savings account as assets, and so on. It would also list any monthly payments due for these items as liabilities. And remember, the difference between your assets and your liabilities is your financial worth, also known as your equity. Okay? That's the general idea. All right? All right, it's the same essentially with your business's balance sheet. It's the same. All right? Okay. So let's talk about this. All right. So a restaurant's asset list would include something like equipment, supplies, furniture, utensils, aprons, dishes, you name it. That's a restaurant's assets, for example. That's an example for you all right there. A restaurant's liabilities, on the other hand, would include money owed to the suppliers, any payroll or anything like that. All right, any payroll. All right, any balance due on credit cards or on a loan. Those would be a restaurant's liabilities. Let's take a look at a contractor as another example. A contractor's assets would include the truck, the trailer, any tools the business owns, for example. All right. And this is key. This is key. The contractor's liability would include money owed for materials, payroll, and so on and so forth, and so on and so forth. Okay, that's great. This is an example of a sample balance sheet. All right. Let's take a look at it in greater detail, everybody. All right. So there is something before we actually dive in here. On the left, let's talk about the word current. Current. What in the world does that mean? Current assets and current liabilities. Anytime you hear the word current, I want you to think, quote, within a year, within 12 months. Okay, current assets are those that will be used or consumed within 1 year. Current liabilities are those that are due to be repaid within 1 year. Okay, so that's important. All right, that's a word you'll see in balance sheets and in other financial documents. Current assets, current liabilities within a year. Okay, what's nice is that you can compare balance sheets from the previous years with the ones right now from the current year. So we have as our example over here, you all see this? March, is it March? I got to move the screen here just a second. March 31st. Assets. Let's talk. Assets. Oops, let me get that little arrow here. Assets right over here. That's great. What's my current assets? What I'm going to use and spend within a year, or have and move around within a year. I have my cash, $1,000. I've got my accounts receivable, $450, and I have petty cash, $100. I also have fixed assets that I have here. Those are not necessarily current, but fixed means, and this is important, it's independent of the amount of business that you do. Piece of machinery, a printer, a computer. You might produce stickers as a business. You might be a sticker company. You're going to need a computer whether or not you make 50 stickers or 5,000. That would be fixed assets. The opposite of that would be variable assets. That is different, okay? And that would be, or assets and liabilities. And again, we're not talking about that right now, but it would be variable. And it would change according to what you produce, okay? So here we have fixed assets of $250. It's a printer. Here we have inventory. Our total assets, $2,000, you guessed it, $200. On the left-hand side, I have my assets. This is where your, and this is key, this is where your assets are going to be located. They're on the left. You see them? They're right there. Easy peasy, ready to go. And there you go. Now, it's a small balance sheet that we're looking at here. We have here liabilities and equity. So let's take a look. Liabilities and equity. I have a liability of a credit card. I have $1,500 on the credit card. And I owe $275. That has a total liability of $1,775. All right. Very good. But that's not all. I also have my equity. Now, you'll notice that the liabilities are found on the right-hand side, and that's key. I'm going to go ahead and put a square over here so that you can see that it's found on the right-hand side. All right. Usually, on the template that I'll give you, it's found right below. But again, we start with assets, and then we go to liabilities, and then equity. On the equity side, I have, well, equity, $250. That's mine as the owners, right? Plus I have any retained earnings, and again, $175 for a total equity of $425. I add liability and equity together, and I get $2,200. $2,200, it is balanced. My balance sheet is done. My balance sheet is done. Does everybody get it? Okay. Give me a thumbs up if everybody got this slide. It's really important. This one's really important because it shows the example. All right. Thank you, Shonda. Thank you, everybody who's given me a thumbs up. Awesome. Well done. Well done. Well done. Excellent. All right. I get a... Valerie tells me mostly. Yay. Thank you, Valerie. All right. Okay. We're going to see more examples in just a second. So let's keep going. Let's keep going. All right. I have my famous quiz. Now, not really a quiz. It's more an opportunity to teach you some more things about the balance sheet and about its use. It didn't come out right, but that's okay. It's all right. Okay. I wanted to talk to you a little bit more deeply into the use of the balance sheet. Many small businesses fail because of lack of good financials or management's understanding of them. The answer is true. I wanted to add that because I wanted to make sure that you understand how important being able to produce, read, interpret, and understand the financial documents actually are. All right. The three parts of the financial statement, the three financial statements, I mentioned it in passing, is the balance sheet, the income statement, and the statement of cash flows. Those are the three big financial documents. Yes, that is true. And I wanted to add that most common financial reports are CPA reviewed. Yes, you can do that too. If you have a CPA on retainer or something like that, you can send them, do they prepare your taxes for you or something like that? You send them the 3 financial reports and documents. That's key. All right, look at this. Assets are shown on the right side and represent current, long-term, and other. That's false because it's always on the left, not on the right. So that's my little quiz slash not really a quiz, just really to get you understanding and get you more into the understanding of how you position all that stuff. So that's easy. Liabilities are shown at the top right half of the balance sheet and represent the debt of the business. That is true. Okay. All right. Liabilities. And then equity. Equity comes from 2 sources: cash invested by the owner and or retained earnings kept in the business. Right. If you have retained earnings from a previous quarter or something like that, absolutely. Plus any equity that comes in. That's where it comes from, essentially. All right. Okay. And then it can come out once you can draw from that equity to essentially pay yourself. Okay. Very good. All right. Now, before we take a look at my template, I'd like to talk about something else: the use of the balance sheet. Why do we use balance sheets? Well, again, we talked about this. It's a smart thing to do, keeps an eye on the health of the company, and so on and so forth. But with these numbers, you can find what are called ratios. And we're going to talk about these ratios, and then we're going to have some fun. So let's go ahead and make sure to put in any questions that you might have about this in the chat. But we're going to talk about these ratios. Let me see. Where's my draw button? Somewhere. I just lost my draw button. It's all right. But no, these ratios are really, really important. They are incredibly important. Okay. You're not the only one interested in these ratios for your company. Banks will be interested in these ratios too. The more that you can learn how to build these ratios from the data found in your balance sheet, the easier it'll be, the better it'll be. So let's talk about these ratios. It's called ratio analysis. And what is it? Well, with these numbers, you focus on numbers from your accounting record. It sets 2 numbers in a ratio. That's right, a little bit of math, and then tracks the trends. The trends are more important than the numbers. Numbers tell you what happened in the past, and the trends tell you which direction you're headed in the future. So take any balance sheet, I even have one right here. If you look at, any balance sheet, plug in some numbers in a ratio, and I'll show you exactly how to do that. Okay. Then you get a ratio over 1 or over 2 or something like that. That number will help you identify the health of your business and see where you're going in the future. Okay. That's key. There's a number of different ratio types. The first one is called the liquidity ratio. It evaluates the business's liquidity, ability to pay its short-term obligations. It's used by banks to decide whether to loan money. Okay? So for example, you want to go ahead and go to the bank and ask for a loan. They'll say, go ahead and give me your financial documents. You present to them the balance sheet, the income statement, and the statement of cash flow. And what happens? They run a ratio analysis, a liquidity ratio. The next one is called the leverage ratio. And it evaluates how much debt a business has. It's a comparison of assets to debts. The next category is called efficiency ratios. How much a business spends to make $1. It's used to judge the management of a business, and that's key. The next 2 are known as operating ratios. Compares expenses as a percentage of revenue. Okay. Banks prefer this number to be low because it suggests that expenses are a small cost of making the sale. All right. The last category is called the profitability ratios, the capacity to actually make a profit. It determines the bottom line for managers and return on equity to investors. And that's key. Remember, when you present, and this is important, when you present your financial documents to a bank or an investor, they're not just holding on to the documents and going, oh, you did your homework, and that's it. No, they're running some math equations on there to see if your business is healthy. So this is what we're doing with ratio analysis. We're understanding these ratios. The four most common ratios are debt to equity ratio, current ratio, return on equity ratio, or the net profit margin. Now, you might have heard of the net profit margin. It's pretty famous. You turn on CNBC or Fox Business or any business channel like that, they'll talk about net profit margin having gone up or down for a company or something like that. That's determined by the information provided in the balance sheet and run through a ratio. I see a question in the chat. Let me finish the ratio part and then I'll get to it in just a bit. So the first one is the debt to equity ratio. And if you're taking notes, it is total liabilities divided by shareholder equity. So as an example, all right, let's say it's $50,000, 50,000, and a shareholder equity of 120,000. Where do I get these numbers? From my balance sheet. That gives me a debt to equity ratio of 0.42. Translated into English, that means that for every dollar in equity, the company has 42 cents in debt. Does that make sense? So that's important. That's important. All right, to know. Debt to equity ratio, remember, debt to equity ratio of less than 1 is ideal, okay? Less than 1. And bankers consider it a ratio of 2 to be risky. Let's take a look at the current ratio. The current ratio is, remember, current means within a year, okay? It's the current assets divided by the current liabilities, all right? Can you liquidate your assets and cover the liabilities? That's the question the current ratio answers. Give an example. Charlie's contracting business. We have current assets of 25,000. All right, that's within the year. Current liabilities of 100,000. That gives us 0.25 or 25%. That means that Charlie has enough current assets to pay off a quarter of his liabilities. He's highly leveraged and risky. Number 2, or next one. Banks prefer a current ratio of 1 to 2 so that current liabilities would be covered by current assets if it were needed. All right. So far, so good. That's our second ratio. Again, the current ratio, you want the higher the better. All right. The higher the better. Current assets, you want those assets to be greater than the liabilities. For example, if the ratio is 4, that means that a company has 4 times more assets than it does liabilities. That's a healthy company. The higher the better. Okay. So far, so good. Oops. Now I see the question. Can you go back to the previous page real quick? Oh, I'm sorry, Valerie. I went a little fast. I was going to do your question in just a second. It's all right. It's all right. I'll get to that in just a bit. The next one is the return on equity, a measure of profitability. Okay. So the return on equity is the amount of net income returned as a percentage of shareholder equity. All right. It's calculated by doing net income divided by shareholders' equity. I'm going to drink some water here. Okay. So it estimates the profitability of a business by showing the amount of profit generated with the money invested by its owners. Net income, not current, the net income, that's at the end, okay, divided by the shareholders' equity. That's your return on equity, a good measurement of profitability. Return on equity ratio, it's similar to this is similar to a person putting cash into an investment. The person will want to know what his or her money is making for him or her in that investment. In other words, they want to evaluate the success of the investment by knowing how hard their money is working for them. Very key, very important. The higher the return, the more profitable the business, right? And last but not least, the net profit margin, everybody, okay? The higher the net profit margin shows, a higher net profit margin shows more efficiency of the company at converting its income into actual profits, all right? So the ratio is a good way of making comparisons between companies in the same industry. Can you turn that income into an actual profit? Don't forget the difference between income and profit. Oh, my business, we have $300,000 in income. Yes, but you might have $400,000 in debt, right? Or it might take you a lot of money to get that income. You want to know if you're making sales and if you're making profit, and that's key. Net profit divided by net sales. So that's the formula right there for our net profit margin. So as an example, we might have net profits of $15,000, net sales of $45,000. That gives us about 33%. So 33% of every dollar of revenue turns into profit. That means that 33 cents of profit is generated by every dollar of revenue earned. Net profit margin. So imagine a restaurant where sales are increasing, but the cost of ingredients is also increasing. Maybe we have inflation or something like that. This could cause a lower shrinking of net profit margins, even though the sales are increasing. All right. So that's important to note and understand. Oops. All right. Last but not least, let's talk about the break-even analysis. Okay. That is not one of our 4 ratios, but I did want to talk about that. Okay. The break-even analysis helps us understand where we need to be to break even, essentially. How much do I have to produce to break even? What's the price I need to charge to break even? And the formula is as follows. Please write it down. It is total fixed cost divided by, you ready? Total sales minus total variable cost divided by total sales. That's a longer one. You don't necessarily have to do a break-even analysis, but it's an important tool for decision makers. But remember, unlike ratios and trends, it doesn't look into the future. So as an example, we could have total fixed costs of $66,666, total sales of $150,000, total variable cost of $60,000. That gives us $111,110 as an example. The break-even point was when we reached $111,110 per month, let's say. Okay? That's important. So suppose you're in a restaurant, for example, right? You'll want to know that. Okay? If the average average dollar amount per guest in a restaurant, let's say, is $45, and you calculated that the break-even point was $111,110 average sale each month, that means that the break-even point is about 83 guests per day in a restaurant, as an example. Okay? So it allows you to do that. Ratio analysis helps you look at the health. Break-even point really allows you to look at the present situation and see where you need to be in order to break even. Remember, with ratios, remember, it's all about looking at all the ratios together, not just looking at one number, right? That's the general idea. So don't be scared if one ratio is lower than you expect it to be. All the other ratios might be good. The break-even point might be good. You know where you are in order to break even. So take it as a bundle. Does everybody get that? Give me a thumbs up if you all got that. All right, take the idea. Thank you. Thank you. Everybody, give me a thumbs up if you got that. Take the ratios as a bundle and don't over-focus on one ratio. Look at all the ratios together, okay? Very, very key, very, very important. All right? So Nick, Valerie, Ashton, everybody, Gabe, thank you. Let's keep going. Oops, where am I? Here I am. Here we go. All right. Okay. Let's take a look at another quiz of mine, which is not really a quiz. All right. Are you ready? The most important and critical element of organic business growth is the intelligence of the business owner. No, the critical element for business growth is the availability of equity capital. Understand that, all right? You don't have to be good at math. All you need to do is know some divisions and how to plug in some numbers inside a balance sheet that I'm going to go ahead and give you in just a bit, okay? All right, next one. Total assets equals total liabilities plus your equity. Yes. All right, that is true. Absolutely. Keep that in your mind. Write it on a piece of paper, all right? That is the formula. Know it by heart, all right? And that ensures that you keep it balanced, all right? Okay. What are the three documents? Again, balance sheet. We've been talking about balance sheet during this whole time. Absolutely. Income statements. Yes, income statements. Absolutely. And statement of cash flows. Right? Absolutely. I'm going to go ahead and share a balance sheet with you. And not only that, I'm going to go ahead and give this one to you by sharing it. And I'm going to go ahead and share it. I'm going to copy the link and I'm going to paste it in the chat. All right, everybody. Can everybody please click on the link, all of you, in the chat that I just sent out? One of you just did. Thank you. 2 of you. 3 of you. Very good. Eager beavers, I see. 4 of you. Very good. Let's make sure we have everybody. All right. Our next thing, my next thing is for you to go to File, Make a Copy. Please don't write on mine. Please don't write on mine. Go ahead and click on File, Make a Copy. And then we're going to spend the rest of our time together going and talking essentially about the balance sheet.
Why not? Darn it.
Oh, it's not working, Heather?
This new computer has trouble with the sound bar sometimes. Oh, why?
It's all right. It's all right. Just it's in the chat. Just go ahead and just give it a try. Okay. And then you'll see it. I can hear you, Heather. That's great. Do your best to try. I want to be really, really clear that you have balance sheet templates for free online as well. You could just Google it. It'll give you templates galore. This is just one of them, right? One of them. Make a copy and keep a copy for yourself. It is right here. We're going to fill it out. We're going to do this together. It'll be interactive. It'll be fun. All right. And it has examples. This is sort of a generic one, as I promised. It's got examples of the different things you can put into different categories. Again, it's not an exhaustive list, but it's there. All right. Let's do this. Let's do this. So Let's do this. All right. I'm going to go ahead and start with this balance sheet. Did everybody notice? This is fun. Did everybody notice that this is one financial document down here on the bottom? Look at that on my screen. Look at that on my screen. It also has a template for an income statement and a template for a statement of cash flow. It's got all three. Okay. But our focus today is the balance sheet. The balance sheet. So we're going to go ahead and do the balance sheet together. All right. It's awesome. It'll be great. All right. So let's do this. All right. Cash. Let's say I have $3,000 in cash. Nice. Okay. Inventory. I have $500,000 in inventory. I have $25,000 in accounts receivable. I have $0 in prepaid expenses. And let's say that I have $15,000. Oops, there you go, in my short-term investments. That's just 5 categories in the current assets. 5. You can put more. You can add more. You can put fewer. It doesn't have to be anything fancy. If you're starting out, it could just be cash and cash equivalents. And that is it. All right. In my sample here, I've given myself $543,000. Okay. Very good. Here are my more fixed assets or long-term assets. Do you see it? Any long-term investments? Yes. Let's say I've invested and I have $120,000. Okay. Property costs or anything like that that are coming to me, let's say 0, 0. Any intangible assets, 0. Let's say 120,000. All right, great. Other assets, anything else that I might have, right? Any other assets, deferred income tax, maybe, okay, or something like that. All right. Any bond issues, prepaid pension costs. I don't know. Any other assets, let's say 3,000 right there, okay, or 4,000. All right. That gives me total assets of $667,000. Great. I'm going to put 0, 0, 0 here. What am I doing? I am filling it out with some fictitious numbers just to show you how it works. You all have a copy, and you can follow me, do the same thing. You can start plugging in some of your real numbers. It's totally up to you. Totally up to you. You can also generate these using a program like QuickBooks. You don't necessarily have to do it by yourself. You can have QuickBooks do that for you. Okay, easy peasy. All right. All right, now let's go to liabilities. Any short-term debts? Yes, let's say 24,000. Okay, short-term debts, of course. Any wages payable? That's a big one. $500,000? Absolutely. Any dividends payable? No, let's say no. Maybe accounts payable? 24,000. Any income taxes payable? Let's say 67,000. Nice. Are there any long-term liabilities? We're not talking about the short term now. We're not talking about current. We're talking about long-term. Anything above a year, all right? Any long-term debts, maybe capital lease obligations or something like that. Again, these are just examples. You don't like this template? Don't worry. Go ahead and go on Google, find another template, and you can go ahead and find those. They're really easy to find. There are dozens and dozens of them, all right? Let's say we have long-term debt of, I don't know, let's say $40,000, and current lease obligations of 0, all right? Great. That gives me total liabilities of $655,000. Remember the total assets, 667,000. And there we go. That gives me the two assets and liabilities. All right. The rest is what's owed to me. To me, as an owner. Okay. All right. Maybe I've some retained investments of 12,000. All right. And that gives me $12,000. Very good. And so on and so forth. Let's say owner's investment this cycle was 0. So nothing in particular. I haven't put anything here, but I have retained earnings of 12,000. I don't know. No other equity. Okay. I know that it's balanced. I know that it's balanced. All right. Why? Because 655 plus 12 equals 667. I made sure that it was balanced. My numbers would show that it's balanced. The numbers I plug in would show that it's balanced. If it doesn't meet that equation, then the numbers aren't balanced and there's an error somewhere. And at the bottom, do you see it? Do you see it at the bottom? Went ahead and added 3 ratios. These are just 3 random ratios. You can add more of them at the bottom if you would like by doing a simple formula. All right. The first one is the current ratio. We talked about that. Okay. Remember, there are dozens of ratios. We saw the common 4 of them. This is 3 different ones. Okay. The debt ratio, the debt to equity ratio, and the current ratio. All right. Current ratio gives us 0.883. Again, you don't have to look at the ratios. You don't have to do it. You can just delete this whole part and just use the balance sheet up here. We just went ahead and added a couple down here just to show you an example. Okay. All right. Current assets divided by current liabilities. All right. 883. That's pretty good. Okay. We want that to not be over 1. Or actually, we do want it to be over 1, but yeah, there you go. Current assets, 667,000 divided by current liabilities. All right. Okay. So far, so good, everybody? And then the idea is that this would be for a specific day. I want to be very clear and remind you that this would be for a specific day. November 6th, 2023. All right. Put in your company name, put in your company address, and it'll all be there. Okay. Oops, I see a question. There is a question. Do you have a template for organizing monthly expenses and balancing bank statements? Sadly, I do not. I do not. The only template I have are for the 3 financial documents in question. That is a very good one. What I will do is for subsequent classes, I will create that template. I just don't. Probably the best thing to do is for you to give it a go and try to Google it and find a free template. There are dozens of free templates online, right, for organizing monthly expenses and balancing bank statements. Or if you're brave enough, you can always make your own. You can always make your own. This can be done by adding another tab down here, right here, and then making your own. Date, description, amount, and so on. I'm on my I'm right here on my sheet here. All right. You could go ahead and do that. Okay. And just make your own. That's what's great about spreadsheets. So it depends on your comfort with spreadsheets and all of that. So I hope that answers the question. I do apologize. I don't have one, but you can ask your SBDC advisor. The SBDC advisor will have these as well. I'm just a program coordinator teaching these classes. I don't have one right now. I probably should have, but it's all right. Thank you. So that's what I would say. All right. Thank you, Valerie. Thank you. No worries. I will ask them. Absolutely. Absolutely. All right. Very good. Just a quick overview of, so we had the balance sheet, which is right here. The income statement, it's all here. All right. Income statement will have the same type of questions. Income or loss equals assets minus expenses. So this is different than what we were talking about today. It's a different one, but I just want you to know that it's there. The statement of cash flow looks a little bit different. Okay. Cash flow from 3 activities. And again, from operating activities, investing activities, financing activities, plug in the numbers, you get the statement of cash flow. Don't forget to put the cash at the beginning of the year right over here. Our focus today was on the balance sheet. So that's why we spent so much time looking at the balance sheet, but there you go. All right. I want to make a plug in here for any programs that you could use like QuickBook or Xero, Xero. If this is something that you're interested in, these are very common programs. Chat with your SBDC advisor about that, but also understand that they can produce balance sheets for you. They can produce income statements for you. And like with QuickBooks and Xero, you can connect them to your bank, which is really nice. You can connect them to your bank. So I'm going to make the plug for that. So you can use the templates with the balance sheet templates like I showed you. You can search for other ones that might be more comfortable for you. You can search for other templates in general, or you can use a program like QuickBooks, Xero, or any other ones like that in order to help you. Those programs come at a cost, but they're there for you. You can use them as ledgers, producing reports, and so on and so forth. Vi had a question, QuickBooks and what? Xero. I'm going to type it in right here for you. Xero. Everyone in the meeting, Xero. It's just an alternative to QuickBooks if you're not familiar. Yeah, that's a company right there. Okay. So it's not, again, I'm not promoting QuickBooks or anything like that. I always like to make my own. So it all depends on how you want to do it. All right. Groovy. Awesome. Let's get back to our PowerPoint slide. We are almost done. All right. There we go. Balance sheet, income statement, and statement of cash flow. All right. In the chat, everybody, what was the most helpful or interesting thing in this presentation for you from today's presentation? Go ahead in the chat and tell me what was the most interesting part of today's presentation. Go ahead. Sort of a little reflection. Vi says everything. Well, thank you. Thank you. That was great. Absolutely. Go ahead and tell me in the chat, everybody, what was the most interesting part of the presentation, things that you learned the most. The resources, says Renee, absolutely. But it's nice to see the numbers on the screen and the balance sheet, says Valerie. Thank you, Valerie. Deborah says in a direct message, your enthusiasm, it's a dry topic. I try to be as enthusiastic as I can with my groups. Absolutely, absolutely. Shonda says the templates were extremely helpful. Great, 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 great. It can be a dry topic, yes, but it is fundamentally important. The numbers are the backbone of everything. And so I want to be, I want to express my enthusiasm about that, about how it's so, and with enthusiasm, I want to express it. So that's key. Well, thank you, everybody. And I want to make a plug for next week. Next week, I hope to see everybody here. We're talking about end of the year tax preparation. A week from today, November 13th, 10 a.m. It's going to be Prevost again. It's going to be me. Yes, very good. Valerie's already registered. Yes, all right. So you're going to see me. We're going to have another presentation. Very good. I want to make a plug for our team here, Eric, for Eric and everybody else. We are the SBDC Small Business Development Center at Blue Mountain Community College. We're talking Umatilla, Wallowa, Baker counties, business advisors for you. Give us a call. The best way is to give us a call, 541-278-5833 or sbdc@bluecc.edu, sbdc@bluecc.edu. And we are here to help. As a program coordinator, what I do is I teach and help pass on the information and along with other things. But our advisors are there and they work one-on-one with you at any stage of the business development process, from your business ideas all the way to business growth and everything like that. So it's great. It's awesome. We have an amazing team. All right. And we're a minute early. I'm here until the last person here. I'm here for questions, everybody. So feel free to unmute and may we have a copy of the slides. The entire Zoom presentation is going to be on our YouTube channel. So search for us at on YouTube, SBDC at BMCC, and you'll see it. It's going to be there. So that's the way that we do it. The whole presentation is back there. I'll be here and helping anybody here. And it's 11 o'clock. So 11 to 11:30 is our question time. So if you have any questions, please feel free to ask. Can you help with church business? That would be a question for an advisor. Vi, that would be a question for an advisor. Give them a call. We work with for-profit businesses. That's important. We work with for-profits. And so maybe there's a sector of the church business that is a for-profit or something like that. But generally, that's what we do. Yeah, absolutely. Give them a call. Give them a call. That's important. Anybody else? Feel free. And if not, I will see you next week or not. Whatever works. Thank you. Thank you. Any more questions? I am here. Thank you so much, Valerie, Shonda, Gabe, Heather, our friend Nick, Renee, our friend on the iPhone. Thank you. See you next week. Absolutely. Absolutely. Thank you, everybody. Feel free to disconnect. It's all good. 541-278-5833. 541-278-5833. It's who we are. It's what we do. All right. Thank you, everybody. Thank you so much. All right. Our friend on the iPhone. All right.